Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, March 22, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And boy, did the market get clobbered today. So we have a lot to talk about. So let's just start with where we were and where we are. So where we were was we were trying to get up above the moving averages. That was yesterday. We came close to the 20-period moving average. The market was rejected. That was on Fed Day. So the Fed had their announcement. The market finished near the lows of the day. Last night, we discussed the fact that that was not a good sign. That was a negative sign. Finishing near the lows of the day after a Fed announcement like that was likely some trouble for the market. That's also why we started talking about these lower levels, and I started emphasizing where the market was likely to go on a sell and then on a hard sell. So we certainly saw the selling today. So we no longer need this 274.40. That's off the table. It's not important right now. So what we do need to discuss is there more downside in this market? And if so, where is it? And where would the market likely stop if there was significantly more selling pressure? First, let's talk about the support levels that we identified at 267.61, 264.82, and then 262.93. For this, I'm going to go down to an intraday chart. Let's take a look at what happened. So the market gapped lower. We came right into the 267.61. We spiked through it a little bit, but then we popped right back up and had a nice little rally. In the big scheme of things, this doesn't look like much because of the magnitude of the selling today. And by the way, obviously you already know this, but we had a Dow down over 700 points today. S&P 500, the SPX cash index, down 68 points, 2.5%. The Dow is down almost 3% today. We'll get to the transports and the broker-dealers in a few minutes. But this was just an absolute thrashing in the markets today, and I don't necessarily think it's over. We'll get to that in a moment. So we came into the important 267.61, and we did have a bounce. This bounce represents about 12 S&P points. So if you look at it, 267.61, this candle made a high of 268.87. So roughly about $1.20, $1.25 in the SPY. That amounts to about 12 or so S&P handles. On a normal day, 12 S&P points is a nice little rally. But when you look at the magnitude of the selling, it doesn't look like much. But what happened was, and this is where a lesson can and should be learned. What did we do? We consolidated right over that level. This is right out of the course at lazyemintrader.com. These are the type of things I teach. I teach how to read the markets. That's what's important. On a day like today, you're able to read the markets. Nobody reads them perfect each and every day, but my goal is to teach traders how to read the markets, to read whether the markets are likely or susceptible to go lower, or the markets are likely finding a low and likely to bounce higher, what to look for, and what patterns will typically tell you that the market is A, likely to go lower, or are we putting in a bottom, and is this a bottom that's going to hold for a while, and could we buy a market for a rally higher? Well, when the market consolidated over this 267.61, it was pretty apparent that the market was going lower. It also consolidated over that level for a very specific amount of time before breaking down. Again, that's specifically taught in the course at Lazy E-Mini Trader. You have to understand that time is more important than price when looking at these markets. The market will respect time just as much, if not more so, than price. Time is extremely important in all markets. And that applies to all charts, all time frames, hourly charts, 10-minute charts, daily charts, weekly charts, monthly charts. It doesn't matter. Everything in between. Time is much more important than price. Then let's look what happened. And here's another way we can learn a lesson from this. The market started to come down toward the 264.82 level. That's the level I identified and thought would be important support for the market. We came up short. I never like when that happens. So I am comfortable with my numbers. I'm comfortable calculating my numbers. I'm comfortable with the way that I teach how to calculate and identify support and resistance in all markets to my traders through the course. We didn't hit the number. That's an important development for me because it told me a couple of things. Either that was a bullish sign and that we were likely to go higher. Sometimes when we don't hit a number on the downside, that's a sign of strength. However, there were other indicators that told me that wasn't the case. We'll get to those in a few minutes. But what did we do? We bounced right up back to the 267.61. What you learn about markets is what is once support will then become resistance once we get below those numbers, and what is resistance will then become support. So numbers are important whether it's from the overside or underside of numbers. Support becomes resistance, resistance becomes support. Look what happened to the 267.61. Once we broke below it and we rallied back to it, the market stopped short right at that number, sold off. Now this looked like a pullback pattern that we were going to go higher, and that's exactly what happened. But that number around 267.61, now you can call it 267.70, 75, 60. We're talking about pennies here. It's not really that important. It's the concept of finding an area that is likely to be support and or resistance for a market. And you can see what happened. That was rejected once again. We made an important trend change signal candle that's also taught in my course. And the market then again rolled over. So once that level was broken, 267.61, we were not able to sustain for any length of time the market above that level. That was an important development. The market began to break down, and guess what? Here was my final line in the sand in the afternoon. Once we closed below the low of this green up candle, and that's considered in my world a breakup candle, once we considered, or breakout candle, wherever you want to look at it, once we closed below that low, that was all she wrote. The market was going down. And the fact that we came close over here and then rallied up and came down with some velocity told me that we were unlikely to see any kind of significant bounce at the 264.82, 265 level, 264.75, in that neighborhood. We really didn't spend much time floundering around that area. And that's what I talked about before, is we came close in the morning, bounced up, and when we came back down, that diminishes the importance of that level. Just like in my gap trading course, I teach the same exact thing. Once a market comes close to a level, and then it bounces higher, and then comes back to that level, that's not the same probability trade, not the same probability support level it would have been had we come straight down to that level on this run here in the morning session right there. If we came straight down to that level, we would have had a tremendous bounce off that level. We came up short, we bounced. Once we came back down, it's not the same trade. It's not the same importance. That level doesn't have the same importance from a support perspective. Here I want to look at the hourly chart for a second, and I want to point something out that's very important. If you're not short the market and the market is going down and you would like to be short the market, okay, where is it possible that you can short the market with a limited amount of risk on a day like today? I'm giving you an after the fact, a Monday morning quarterback look at the market and telling you where a likely level was where you can keep your risk to a minimum, yet take advantage of the potential downside that was coming if it were to come at all. Well, look at the second candle of the day. You see that that's a breakdown candle. What I teach in the course is that breakdown candles are extremely important. I'm not going to go into all the details here. You have to take the course to find out, but they are very important. So what happened was that the market rallied up for the next couple of hours towards the top of the breakdown candle. So that's an area that traders were able to take a short trade in and around the top of this breakdown candle. Why is that? Well, I teach you where you're wrong in the course. You have to always know where you're wrong on a trade. That allows us to keep our losses to a minimum. We like to lose small and fast, but we like to be able to take a trade, what I call as close to risk as possible. This trade was as close to risk as possible. Taking a short trade near the top of that red breakdown candle from this morning, right here, kept risk to a minimum. Why is that? Because any hourly close above the top of that breakdown candle would have told us that we were wrong on the short trade, the market was likely going higher, and we would have to move away from that or out of that trade. Well, we never did close above the top of that breakdown candle, and look what happened. The market went down for 3 hours in a row, very, very strong, with a lot of velocity, and it was a big number at the end of the day. And I know it's not easy taking a trade against the grain, and what I mean by that is, you see, for a couple of hours, we were trading up, and it looked like the market was recovering. So it always feels when you're taking a trade against the grain like you're doing the wrong thing at the wrong time, but that's the way the market's designed. The market is designed to make you look like, not you, but make traders look like fools as much of the time as possible. It's designed to make you think you're doing the wrong thing at the wrong time. When you think you're doing the wrong thing, it's usually the right thing. When traders buy into momentum, when they buy something on the way up, by the time they make a decision to buy, they're likely buying too late, which is why we find ourselves out of the money immediately buying momentum, because all of a sudden a stock will turn around or a market will turn around and go the other way, and we feel stupid like we bought at the top. Same thing happens at the bottom. When we buy into a break, when we buy when the market is, it's called selling in the hole. When we buy after a market is down, when we sell after a market is down a lot, that's too late most of the time to sell. That, even though it feels like you're doing the right thing, it feels like you're hopping on the bandwagon, and then what happens is, all of a sudden, the market finds a bottom, reverses, you find yourself out of the money, and you find yourself covering the short trade in a panic buy scenario. That's called getting whipped out of the market in either direction. We don't want to do that. The market's designed to, when you take a trade and it is the correct trade, it's not supposed to feel exactly like it's the correct trade at the right time. That's under normal conditions. Once you get used to this and you learn how these charts work and you learn the strategies and techniques that I teach, it won't feel wrong after the fact. After you learn these things, it'll feel like you're doing the right thing at the right time. But keep in mind, the market is designed to make as many traders as much of the time look like fools over and over and over again. Our job, or my job, is to not let that happen. Our job and my job is to teach and train traders to do the right thing at the right time for the right reasons. All right, back to the daily chart. Where are we going from here? Well, the 262.93 number was an important number. It is an important number, but it wasn't hit today. We came close and we bounced a little bit away from that number. So as it stands tomorrow, that number becomes somewhat less important if we're going to sell farther. We came close to that number. We could certainly gap below that number. But what I'm going to do is I'm going to move this level down one notch to another or the next important area. That's the number we have to watch out for into Friday or potentially Monday. I'm not suggesting we're going to get another hard sell tomorrow. We may find a gap down in the morning. There's certainly going to be some margin calls to be had in the morning. That's the way it works. When you have a day like this and there's heavy selling and there's hedge funds and there's individual traders, individual investors trading on margin, there's going to be margin calls. That will be some forced selling in the morning if that's the case. So if that happens, 261.66 is the next important number on the downside. If that number is broken, if that number is closed below, beginning hourly, and then if we close below that number daily, look out below. There's lower and potentially much lower prices coming. If the 261.66 is closed below, then what comes into play is double bottom. I'm not saying it has to happen. I'm not saying it's going to happen. I'm saying it comes into play. You also have a 200 period moving average. You'll get some support there, but I'm just suggesting that somewhere in this neighborhood comes into play if we close below 261.66. I'll have that number refined if we do close below that number. Right now, that's an important number. That number has to hold. That has to hold on a daily chart closing basis. Otherwise, much lower prices are in the cards. Looking over at the IWM got thumped today. We were down almost, or about 2.5%, almost $4 on the IWM. That's a thumping. Just yesterday, I was saying, technically speaking, and that was correct. Technically speaking, there was nothing wrong with this market. We were above all the moving averages. We tested the moving averages a couple of days ago. It was in a bullish position. Now look where we are. We're below the important trend line that comes over from the monthly chart. This month's close is going to be extremely important, and I say that each and every month. The month of March, if we close back below that line, that will be a failed breakout attempt, and there are much lower prices in the cards. Right now, we're hovering right over the 100 period moving average. That's an important number. All markets are basically trading together. And today, you can certainly have taken a cue from the IWM and the transports. Even when markets were bouncing, these markets, the IWM and the transports, were still down significantly, not showing signs of a rally. And that's how you knew, on one hand, that it was not a day where the buy the dip crowd was just going to step in and buy up the market. You didn't get that cue from the IWM. You didn't get that cue from the transports. You can see here, very heavy selling pressure. We had the intraday bounce just like the spiders did. However, look at the selling in the afternoon. It was just perpetual. There was virtually limited upside in the afternoon. It was just a thrashing all around the clock. The IWM, the transports, the spider, the Dow, the NASDAQ, everything got taken out behind the woodshed. These are the days when you do not, and I repeat, do not try and pick bottoms in the market. The transports. Remember the bearish pattern that we talked about for a couple of days in the transports up here. We had a down move, and we said it was conflicting, right? We had the up move, and this could have been consolidating underneath the 50-period moving average to move higher. But I said when there's conflicting patterns, it's likely, you don't know which way it's going to go, so you don't do anything. So here we are, bearish pattern. We consolidated in a bearish wedge fashion underneath the 50-period moving average, couldn't close above it. We consolidated in a bearish wedge for a very specific period of time. Again, this is right out of the course at Lazy E-mini Trader. And what happened? Here's the finishing move to the downside. We're probably not done yet with the downside, closing below the 100-period moving average, unless we recover it very, very quickly, is a bearish sign. Likely lower prices are coming. You'll get some support here at this double bottom pivot here, and if that doesn't hold, you have your 200-period moving average and your double bottom down here. So if this market doesn't recover quickly, and that level in the spider doesn't hold, that level, and I'll bring up the spider chart one more time. If this level 261.66, if that doesn't hold on the daily chart, then look out below. All these markets are susceptible to a much, much larger decline. Here's a 10-minute chart of the IWM. Of the transports. Just want to point something out that traders can take note of, because this applies on all charts, all time frames, any vehicle you want to look at. Here's what my point is. Here's the gap lower, and then we had this bearish wedge pattern before the breakdown. This is a consolidation point, okay? So we did that in the morning. The market sold off, and then we rallied back. So the market sold off. It found an interim bottom. Now, we don't know whether or not that's going to be the low for the day or not. But at the point in time, that's a low. We rallied back, and it's the same look as the spider. We had this little bullish wedge pattern, and then we had another rally. We put in a signal of a trend change. Let me clean this up. We put in another signal of a trend change. Those traders that have taken the course know exactly what I'm looking at. But what I want to point out is, you see this consolidation point? Where did we rally back to before we broke down again? We rallied back right into that consolidation point. Could it have been, a couple of bucks lower, a couple of bucks higher? Yes. But we rallied right back into an area that the market told us was an important area. We consolidated in this area for a period of time. It's an important period of time. Again, time is more important than price. Go over this in great detail in the course, how to use time to your advantage. So the market rallied back to that consolidation point, couldn't get through it, put in the signal of a trend change, and broke down for the rest of the day, just like all the other markets. You can learn how to do this, folks. You can learn how to read markets. You can learn how to read charts. If you can learn how to read charts, you can make money in these markets. Let's switch gears and go over to the gold market real quick. Had a little bit of an up day in gold, but not too much. It wasn't up as much or commensurate with the amount that the stock market was down, which tells me that, gold really isn't getting a bid, the type of bid that you would expect if gold was going to rally higher to a large extent. So there's really no change until and unless we get above this area here on a daily chart closing basis or below this area here. We're just in a range. Until that, one of those two things happen, this is just in a trading range. Very difficult to read, very difficult to trade. If you can get above, we can rally. If you get below, we will break down. In the middle of the range, there's not a lot to do. Not a lot has changed in the gold market from the last several sessions. We're going over it, the same thing over and over again each and every night because we stay in the middle of this range. We're still caught below the 50-period moving average, making an attempt to get above it. That's fine. If they do get above it, we still need to get above this important pivot high in order to rally substantially in the gold market. Until and unless that happens, we're just trapped. That's it. Down day in crude oil today. Not too bad. I mean, we're still above the $64 level. That level is extremely important. We're somewhat, or at least for the time being, rejected at the 65.23. We talked about the fact that 65.29, in fact, I'm going to move this up to 65.29. I should be consistent. That's a weekly chart number, but let's be consistent with the lines on the chart. 65.29 is the number that's extremely important based on Friday's close. It's the weekly close. So right now we're rejected. We made a high today before we broke down of 65.74. So we're making an attempt, but the market sold off, but we're above 64. So right now it's not too bad. It's just a pullback. We had a very, very nice rally for several days in a row. So we have a slightly overbought condition on a short-term basis. It's not unlikely that it's not surprising that we pulled back a little bit. We could consolidate up in this range up here, and that's fine. If the market chooses to consolidate up here in this range, then it will be building energy for another move higher. It's too early to tell. What we're looking at based on the weekly close, Friday's close, 65.29. Close above that number, extremely bullish. Close below that number, it's not bearish. We just didn't do it yet, and we look to the following week or the following Friday. And with that, it's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.